Disclaimer: I'm Zayd Haji, a student of finance, not an economist, legal authority, or government advisor. The views shared in this podcast are intended purely for educational and academic discussion. They are drawn from publicly available data and are meant to encourage reflection and critical thinking. This podcast does not aim to criticize or oppose any government, institution, or policy. Nothing discussed should be interpreted as financial advice, legal guidance, or policy direction. Please consider this as a personal, student-led exploration of financial concepts. Welcome to the IFR Islamic Finance Research Podcast, part of our ongoing playlist series titled Zayd's Rules, Ethical Finance, the Halal Economy. This series is dedicated to examining the realities of today's financial world through the lens of Islamic economic principles. We are not experts, we are students of finance, asking questions, studying patterns, and trying to understand the systems that shape our lives. In our previous episode, we explored how modern economies, including India's, are built around a cycle of debt and interest. We looked closely at how this structure leads to rising inflation, a growing cost of living, and mounting pressure on both individuals and governments. Despite steady economic growth, many still find themselves struggling financially, not because of lack of effort, but because of how the system is designed. Let's briefly reflect on India's current financial state. The country recorded a GDP growth rate of 6.5% in 2024-25, the highest among major economies. Inflation dropped to 2.82% in May 2025, the lowest since February 2019. Exports hit a record high of $824.9 billion. These are strong indicators of growth and progress on the surface, but underneath, a different picture emerges. Government debt is still rising. According to the latest figures, India's total public debt was 181.74 lakh crore as of March 2025. By March 2026, it is projected to reach 196.78 lakh crore. Of this, over 190 lakh crore is internal debt and more than 6.6 lakh crore is external debt. This ongoing rise in debt reflects a cycle where borrowed funds are used not only for development but often to service previous debt, particularly the interest. This is the backdrop for today's episode, Sharia law in the Indian financial system, a transformative journey. In this episode, we begin to examine how Islamic financial principles, such as the Musharakah partnership model, offer an alternative approach to conventional lending. Instead of charging interest, this model is based on shared ownership and mutual participation in profit and risk. As students of finance, we seek to understand these models not as solutions, but as concepts worth exploring, especially in the context of a country facing the dual pressure of growth and debt. Let's begin this journey into a different way of thinking about finance, ownership, and economic responsibility. Sharia law in the Indian financial system, a transformative journey. Picture this: you're walking through one of India's vibrant city streets, a scene alive with energy. The air is filled with the rich aroma of sizzling street food, a mix of spices that instantly awakens your senses. Horns blare in the distance, rickshaws weave through traffic, and the chatter of shopkeepers calling out to customers blends into the chaotic rhythm of daily life. Amidst it all, you pass a modest fruit shop tucked between larger stores. The vendor, a familiar face in the neighborhood, greets you with a tired smile. You glance at the fruit prices and feel a pinch. Everything seems costlier than it was just a few weeks ago. It's not just the fruit, the price of milk has crept up. Vegetables, once affordable, now make you think twice. Even a simple bus ride feels more expensive. And you're not alone in wondering, why is everything becoming more expensive? What's behind this quiet surge in prices that affects every chai you sip, every meal you cook, and every commute you take? As you continue walking, something else catches your attention. A large, glossy banner stretched across a building, advertising an exciting new home loan offer. The message is bold and inviting: low MIs, easy terms. In a time when the cost of living is rising day by day, it sounds like a dream come true. You pause for a moment, drawn in by the possibility of finally owning a home, of finding some stability in this whirlwind economy. But then your eyes move to the fine print, the part most people tend to overlook. And there it is, three familiar words: interest rates apply. It's a term we've all grown up with. Interest, debt, loans is the language of modern finance. We've come to accept it as normal, a necessary part of how things work. But have you ever really stopped to think about this system? About how it operates and, more importantly, how it affects you? Why is it that with each passing year everything gets more expensive? Why does the burden of debt keep growing, both for individuals and for entire nations? Why does inflation feel like a creeping shadow that never really goes away? What if I told you that the very structure of our interest-based financial system is at the root of these problems? And what if I told you there's another way, a system based not on profit from debt, but on ethical principles, fairness, and shared risk? In this episode, I want to take you on a journey to understand how the current financial model fuels inflation and rising costs. And then we'll step into the world of Sharia law, the foundation of Islamic finance, to explore how it offers a radically different and perhaps more sustainable approach to money, lending, and economic justice. You stop at a roadside tea stall craving a hot cup of chai to take a break from the noise and movement all around you. As the steam rises from your glass, the shopkeeper strikes up a conversation. His tone is casual, but his words carry the weight of concern. Prices just keep going up, he says, shaking his head. The government borrows more money, pays more interest, and in the end, it's people like us who pay for it. Everything costs more now, even this cup of tea. What he's describing isn't just a passing complaint. It's the heart of a much deeper problem in our financial system. This is the reality of an interest-based economy. Every time the government or even a business borrows money, they're not just taking out a loan for the actual amount they need, they're also agreeing to pay interest on top of it. And who ends up covering that growing burden? You do. I do. Every taxpayer, every consumer, every ordinary citizen. Let's break it down. Suppose the government wants to build infrastructure, roads, hospitals, schools. These are essential for progress, but the government often doesn't have enough money on hand to fund these projects. So what does it do? It borrows from banks. But these banks aren't just handing out money, they charge interest. That means the government now owes more than it borrowed. To keep up with the payments, it faces two tough choices. Either reduce public spending, cutting budgets for healthcare, education, and social programs, or raise taxes. Both options make life harder for everyday people. And it doesn't stop there. The interest keeps piling up, so to pay off one loan, the government takes another. It's a cycle, borrowing to pay interest on past borrowing. This isn't just bad planning, it's a trap. As the debt grows, so does the cost of borrowing. Interest rates climb higher, and the cycle becomes even harder to escape. Now think about how this impacts businesses. When interest rates rise, companies also have to pay more to borrow money. Where they need a loan to buy raw materials, expand their services, or simply keep the lights on, it all costs more. And they don't absorb those costs, they pass them on to us. The price of groceries goes up, the cost of education increases, healthcare becomes more expensive. Even your humble cup of chai at the tea stall isn't spared. This right here is inflation in action. It's not just an economic term or a number on a chart. It's a direct result of a system built around interest, a system that fuels a never-ending spiral of debt and rising prices. And until we rethink the foundation of this system, that cycle will only continue. Now picture a different kind of world, one that feels like a breath of fresh air. You've finished your tea and continued down the road when you notice a bank that looks different from the rest. A bold banner outside reads, "No interest, no debt trap." It stops you in your tracks. Intrigued, you step inside. The space feels calm, welcoming. A bank officer greets you with a warm smile. "Welcome," he says. "We offer financial solutions based on Sharia law, an ethical system that's been practiced for centuries." Your curiosity is piqued. "How is this different from all the interest-based loans I've seen before?" you ask. He leans in, slightly happy to explain. In Islamic finance, we don't deal in interest at all. Riba, what you know as interest, is strictly forbidden under Sharia law. Instead of simply lending you money and charging interest, we build a partnership with you. Let's say you want to buy a home. We don't hand over a loan with interest attached. Instead, we help you purchase the house by jointly owning it with you. You pay rent on our share, and over time, as you make payments, your ownership increases. Eventually, the home is entirely yours, without ever paying a rupee in interest. You feel a wave of relief, so no interest at all? But doesn't that affect the economy? What about inflation? That's a very important question, he says, nodding. In the conventional system, the more people and governments borrow, the more interest piles up. That interest makes everything more expensive, businesses raise their prices, governments raise taxes, and inflation spirals out of control. But in Islamic finance, we don't rely on borrowing with interest. We use models like Mudaraba and Musharakah, profit-sharing partnerships where both sides share risk and reward. Instead of taking on debt, businesses grow through investment and cooperation. Suddenly, the bigger picture begins to form in your mind. So by removing interest, you're also reducing inflation? Exactly, he says with certainty. When you eliminate interest from the equation, you cut off one of the biggest drivers of inflation. There's no constant pressure to raise prices to cover borrowing costs. As a result, the value of money stays more stable and the cost of living becomes more manageable. It's not just a different way of banking, it's a different way of thinking about money, one that focuses on fairness, stability, and real economic growth. You walk out of the bank with something you didn't expect to find today, a sense of hope, a glimpse into a financial system that doesn't just work for profit, but works for people. Let's break this down with something relatable: buying a home. It's one of the biggest financial decisions most people will ever make. In the conventional interest-based system, the process might seem straightforward at first. You walk into a bank and apply for a home loan. Let's say the bank approves 50 lakh at an interest rate of 8% for a 20-year term. Sounds manageable, right? But here's the catch. Over those 2 decades, you don't just repay the 50 lakh you borrowed. You end up paying an additional 40 lakh in interest. So by the end of it, that 50 lakh home has cost you 90 lakh. That's nearly double the actual price of the house, all because of interest. Now think about what that means on a larger scale. When more people start taking out such loans, banks pump more money into the economy and interest rates begin to climb. Higher interest rates don't just affect home buyers. Businesses borrowing to fund operations or expansions also face higher costs. And how do they cover those costs? By raising the prices of their goods and services. In this way, the burden of borrowing gets passed down the line until it lands on you, the consumer. Inflation kicks in not as an abstract economic phenomenon, but as a very real increase in the price of everything from groceries to school fees. Now let's compare that to how it works under Islamic finance. Imagine the same scenario, but the different model. Instead of giving you a loan with interest, the bank becomes your partner in the home purchase. This is known as a Musharakah arrangement. The bank and you co-own the property. You pay rent for the bank's share of the house, and with every payment you make, you gradually buy out their portion. Over time, full ownership transfers to you without a single rupee in interest being charged. Here's the key difference. In this system, the bank earns a profit not through interest, but through its share in the property. There's shared risk, shared responsibility, and a clear, transparent process. You're not paying inflated costs just to service a loan, you're paying for something real, your home and the bank's share in it. This makes the entire journey far more affordable and much more stable. In Islamic finance, especially when it comes to home ownership, the focus isn't on profiting from debt, it's on building partnerships and sharing value. And that shift in mindset can reshape how we think about wealth, affordability, and fairness in our financial lives. Let's break this down even further by diving into how the Musharakah model, an Islamic finance partnership, actually works when it comes to buying a home. It's simple, fair, and most importantly, free from interest. In the Musharakah model, the bank and you become partners in purchasing the property. You don't walk in asking for a loan with interest. Instead, you and the bank each contribute a portion of the money needed. Let's say the house costs 50 lakh. The bank agrees to put in 30 lakh while you contribute the remaining 20 lakh from your own savings or perhaps a smaller non-interest based loan. That means the bank owns 60% of the property and you own 40%. Now here's where it gets interesting. Unlike traditional loans, the bank doesn't earn money by charging you interest. Instead, it earns profit by charging rent for its share of the property because remember, the bank co-owns the house with you. This rent is agreed upon in advance and is usually based on the market rate or fixed for a certain period. Let's say the fair market rent for the property is 10,000 a month. Since the bank owns 60% of the property, it's entitled to 60% of that rental income. So you would pay the bank 6,000 per month as rent for its share. That's the bank's profit, not from interest but from its rightful ownership and contribution to the home. Over time, as you make regular payments, you gradually buy out the bank's share. Each payment reduces the bank's ownership and increases yours. Eventually, you become the full owner of the house without ever having paid a single rupee in interest. This model is not just financially sound, it's built on ethics and shared responsibility. It ensures the bank profits fairly while giving you a clearer, more stable path to ownership without the burden of compound interest weighing you down. So here's the simple summary of how the Musharakah model works in real life. In our earlier example, the bank owns 60% of the home. That means each month it earns rent for its share 6,000 out of a total 10,000 monthly rent. This isn't interest, it's fair profit based on the bank's actual ownership in the property. And here's the best part, as you continue making payments and gradually buy out the bank's share, their ownership stake goes down. And because of that, the rent you pay also decreases over time. You're not stuck with a fixed interest rate that drains your finances for decades. Instead, you're slowly taking full ownership of your home while the bank earns profit in a way that reflects the real value of its investment, not through compounding interest, but through a transparent, ethical partnership. That's the power of Islamic finance in action. With that said, I leave you with a reminder. Wealth is not just a measure of what we have, but how we earn, share, and honor it. I am your host, Zayd Haji, a student of finance, an author, and founder of 3 mission-driven platforms: IFR is Finance Research, ISR Islamic Studies Research, and IGC is Guidance Council. These platforms were not created for image or branding, they were built out of necessity, to reconnect divine guidance with real-world systems, to revive amana in leadership, and to reimagine finance through the lens of ethics and faith. Through my books, Investing in Value Stocks, Investing in the Stock Market, Investing in Mutual Funds, and Business and Money for Life, I've aimed to break down financial knowledge into accessible, actionable insights. And through works like Unlock Your Mind and Self-Worth and Self-Esteem, I've explored how emotional clarity and spiritual strength influence our financial choices. This has been another episode from Zayd's Rules Ethical Finance for a Global Audience, part of the IFR Islamic Finance Research Podcast channel, a series dedicated to understanding how money, values, and meaning can coexist in today's world. Join our growing community on WhatsApp and Instagram and explore more at zaydhaji.com and zaydalhaji.com. My full body of work is available in both ebook and paperback formats through Google Play Books, Amazon Kindle, Amazon India, and Flipkart. I am your host, Zayd Haji, signing off. Until next time, stay thoughtful, stay principled, and may your financial path always reflect your purpose.